Good afternoon or good morning, depending on what time you're reviewing the webinar. My name is Marcus Gilmore. I'm the CEO and founder of Gilmore Advisory. Thank you very much for tuning in. This is going to be a very short synopsis or review of the Perth property market. I'm trying to keep it to as close to 20 minutes as possible, so I'm not going to do a big introduction. There is a much more detailed report. This is just high level, and if you are interested, at the end of the presentation there'll be availability to register to get the full document and additional information if required. Most of the data here is provided by Real Estate Institute of Western Australia and also a company Area Search, and they're sourced through the document. And please feel free to make contact with either if you want to put clarification of any of the figures. Firstly, I'm going to start with the state government, or basically where our state economy sits. As can be seen in the yellow columns here, which is the forecast periods beyond 2021, we're looking at very strong and positive growth for the better part of up to 2025, 26. We're essentially entering into the construction phase of a major mining boom. There's various committed projects. A lot of them. I'll use one just as an example, just to give an idea of the potential of what's about to happen in the state economy. The Scarborough project, which is a Woodside BHP joint venture now, $16.5 billion. It's about to commence, likely to go through to 2026. Will employ around 3,200 direct construction jobs, and then obviously ongoing work and export dollars at the end of the project. Essentially, the mining boom, why it's relevant, it has a significant impact on property prices in WA. It'll bring additional wages to our market. It will bring interstate and overseas population growth for the construction and development of the various mining projects. And it also, from a property perspective, and it is an important factor, they take a lot of our housing construction workforce, and it makes it very hard for us to deliver stock in a timely manner. That lack of stock then pushes up prices and also pushes up construction costs, which also pushes up prices. So that element is very much in place at the moment and is going to be a major factor on the Perth property market. So in relation to the state of the market, I primarily use supply and demand factors. I will touch on interest rates because they are relevant, coming off a low base. However, the key focus on price movements, in my opinion, is supply and demand. In the presentation, you will notice I use Sydney as an example of or comparison to Perth, and that will highlight the potential for the Perth market going forward. This particular chart is from the Real Estate Institute of Western Australia. It essentially, in the blue column, provides sales volumes. As you can see, sales volumes have increased significantly since March 2020. And the second chart, the orange line, is our property prices or median house price. As can be seen here, we've had a sustained reduction in prices since the last mining boom in 2013. And finally, after around 8 years, have seen an uplift in prices, and which has been as much as or as high as 20% in the last 12 months alone. So on top of that, again, figures from the Real Estate Institute. To the column, the blue column is the number of properties on the market at any given time, and the orange is the average days on market, on how long it takes to sell. So let's focus on the orange line first. Essentially, we've gone from in the period of less than 2 years, we've gone from 2 months or 60 days on the market down to the actual figures around now 17 days. Many suburbs here, the properties aren't even hitting the market, and there was an article in the paper recently where it's actually down to 5 in particular suburbs, but most properties hitting the market in key areas are getting multiple offers on the first weekend home opens. So we are in a very hot market, and we're expected to see that to continue. In relation to the blue columns, this is the number of listings that are in the market, so properties actively for sale. I use this period, 14,000 homes as my equilibrium, which you can see with the cursor there. Once we go above 14,000, as can be seen through 17, through to 19 and going back to 2013. If you go above 14,000, you typically have price reductions. If you go below 14,000, that's when the market starts to have a shortage of supply and prices increase. Now, we sit currently at only 8,000 properties in the market, which is under half of the peak only 2 years ago in 2019 at around 17,000. So we're half of that in less than 24 months. Another key indicator of the housing shortage is rental vacancy. So we can see here the blue line. This is going back to September 17, where vacancy rates went as high as 6.9%. They now currently sit at 0.9%, and that effectively is, that's the period between putting one tenant in and replacing them with another. It's almost negligible vacancy. People are signing up applications sight unseen to get properties. There's queues and the like at home opens in the marketplace. What that's doing, if we follow the orange line, that's current rental levels. That's increasing rents at a rapid rate. In the last 2 years, it's gone up 23%. And I expect that to continue. And I expect rental prices to continue at a higher rate than property prices initially, but property prices will catch up as the investors return to the market, which I'll touch on in further detail. As noted, I mentioned I would compare Perth and Sydney. So this particular chart here provided by Area Search provides the median house price of Sydney in the orange and the median house price of Perth going back 16 years. What you can see here is Sydney has increased from 500,000 over that period to 1.2 million, which is a 140% increase in the price. Perth, on the other hand, increased from 300,000 to 540,000 only over the same period of time. So that leaves a gap of just under 700,000 between Perth and the Sydney market. And as per the heading here, that I believe is an unsustainable gap. So Perth there'll be a combination, I think. There will be a correction in Sydney at some point, and that'll probably be driven a little bit more by interest rates, which again, I'll explain further down the track. However, it's probably a little bit more the Perth property market catching up based on the mining boom and the huge shortage of supply that we have with the demand coming. Another key indicator is property yields. So we can see here, if we look at the chart, the orange dot, that's Perth's current yield, which is at 5% gross, 5% of gross income, and Sydney at 3.3% and Melbourne at 3.1%. So we effectively have a position where we're almost 40% higher on rental returns than our eastern states counterparts. And it's really important when we look at, I mentioned previously that we had significant sales activity and sales volume. Most of that was driven by first homeowners and owner occupiers, and the investors still haven't returned to the market in full force in Perth. So as yields, and as I mentioned, rents are going to continue to increase. Yields are actually going to get stronger because I think rents will go up faster than property prices. But once we sort of hit around this sort of 6% figure, we're going to start to see, that's essentially double the eastern states. We're going to start to see international and eastern states investors as well as local investors buying up properties within the Perth market. And that again is going to drive activity and further price growth. This particular slide highlights the typical property cycle. So if you follow the cursor, we're going essentially we start at correction, into a contraction, then we're into the recovery stage. I see Perth at this point here, so we're certainly out of the contraction, well and truly into our recovery, and we have a long way to go to reach the top of the market, which is very positive if you're looking at buying as at today's date. We then go from recovery into expansion, and then we hit the top of the market and then head back into correction. So I see Sydney still at the top of the market. I believe that they'll probably have some more growth, which I think is a bad thing because I think it's already overheated. The further it goes beyond the natural market, the quicker and harder it falls, and that happened to Perth in 2014. But in saying that, if you did buy Sydney 4 years ago and around this portion of the cycle, which is about, Perth's not even quite there yet, and we're approaching it. However, if you did buy Sydney property then, you made an enormous profit on the way through. If you're buying at the market now, I think you're in a very risky position and have a lot more downside risk than you do upside. Whereas Perth, you have a much larger upside risk than you do having a downside risk of prices going down. So that basically puts the market into perspective. So what we'll look at now is supply and demand for housing. We'll focus on demand first. And essentially the key driver of demand for housing is population growth. So this particular chart tracks natural increases, which is deaths versus births, overseas migration, and interstate migration. I really only focus, for demand purposes, focus on interstate and international, as babies often don't buy property. So these are the real demand drivers. As we can see here, back in March 2012, pretty much through to, say, March 14, we were having up to 80,000 people. 60,000 of those were interstate and overseas migrants coming into the marketplace. So huge increases in our population, and therefore demand for property. We then essentially, that population growth reduced significantly, and then we leveled out here at around 30,000 people, but the majority of that was natural increase. So we really were looking at only around 10,000 people per annum for this period from March 14 through to around 2020. And a lot of that was as a result of this curve here, which was the negative growth. And that was all of the eastern states construction workforce returning back to Queensland, Sydney and Melbourne after the mining boom was finished. We were just before COVID. You can see the population was tracking back up, international was increasing, and eastern states were, the net result of eastern states was certainly coming back into the Perth marketplace. We then had COVID and the borders closed, and therefore we lost all of our international and interstate migrants and ended up in a negative 0.5% population growth. What I do see, if we take out this one-off occurrence, and we're certainly trending up, and that, I do expect to see a similar trend here, where we had the positive interstate migration, where it was negative in the last few years. That's going to return, and we are going to see a major growth in our population, interstate and overseas investors, now that our borders are open. Our primary demand for increases in housing will come from university students, skilled migrants coming into the market due to the construction boom. We're going to have a lot of expats that have been waiting for the borders to be, or the visa system to be in place, which is effective as of Wednesday this week, the 1st of December. And we also have the interstate workers that are going to be coming back. What I think is important to note, though, what's going to happen with the demand for housing is it's not going to be a certain number per month every month. It's not going to happen that way. It's going to be very cyclical. And what I'll do is use the university students as an example. So this is the chart. This is some information which gives you an idea of the number of international students that we have in our various universities, around 20-odd thousand. There has been, you can see here, some gradual declines in the numbers of enrolments, etc., and that's obviously COVID driven, but we potentially will see those come up in a pretty major way. We had all of the 2020 enrolments defer, plus we've got our 2021, so we may even have a double up of those due to COVID in this year, or probably more likely next year, as those people that did defer their courses come back to Australia now that we've opened the borders. However, so on the government website, they've allocated 5,000 visas for uni students returning to Perth for the commencement of the February semester. If we go back to the amount of housing or the availability of leased properties, as mentioned, we only have 2,000 properties available for lease. By February, that's probably going to be 1,700. We only have 8,000 properties for sale. And most of those aren't just generally around universities or thereabouts. You probably take 10% of those properties being within those locations that may suit those uni students. So fundamentally, we do not have the supply, the availability of property to meet a very, very sharp increase of 5,000 students coming. And they're going to be very competitive looking for property, and they're probably going to end up buying property as opposed to leasing. I just use the university students as an example, just indicating that there's going to be an influx in January, February. There's also going to be an influx in June and July, and then it's going to repeat itself in 2023. So it's not going to be gradual, it's going to be sudden, and that's going to have large spikes. We also have the skilled workers. They've been waiting for this for a long period of time. Those that have been waiting aren't going to wait until March. They're going to come in as soon as they can. Same with the returning expats. And the construction workers from the East Coast are going to be very much led by commencement of construction of projects. So you're going to have spikes there as well. Okay, so that covers the demand, and I think I've covered off that. As I said, I think it's not going to be just gradual. It's going to be these immediate spikes, which is going to have an impact on property rents and prices. Let's have a look at the supply side. So this particular chart, again, provided by Area Search, and the statistics are based from the Australian Bureau of Statistics. The blue column is normal housing, and then we have the orange, which is attached, which is apartments and townhouses. So the last construction boom, let's say here from 2013, September 2013 to, let's go through to the end of 2016. So that's, if we take a 4-year period there, we built 118,000 homes within that 4-year period. And you can see this major reduction in the actual dwelling approvals, which is a lead indicator for supply. If we take this period here, again, same period, 4 years, we only built 65,000 homes. So we essentially half of the number of properties in the last 4 years were built in the previous 4 years. So where we built 118,000, that was an oversupply, and that's why our prices haven't increased over the better part of 8 years. However, that undersupply and this cumulative reduction in supply has now resulted in us only building 15,000 homes as at 2020 September, as opposed to 33,000 at the peak in 2015. The other point, let's have a look at the upswing here. This is 100% COVID driven. This was all the grants given out by the government to keep the economy going. It's important to note that we are talking approvals, not completion. So what we have is a lot of sales that occurred and a lot of building contracts that have been written up, and a lot of free money that was given out, allowing buyers to get into the market. However, what we are struggling with is labour to actually build the homes, and material. The supply chain of materials is very slow, and it's going. Even though they've been approved and ready to go, the fact is that it's going to take a long time to deliver those homes. The other fundamental about these dwelling approvals here relates to the nature of the buyers. Most of them were first homeowners. There's a major increase there. People that were kids that are living with parents, all of a sudden being given free money to go out and secure their first home. So that's not going to make any structural change to the supply issue. It's existing residents that were already here that have been able to move out to their own home. It's not going to cater for the additional demand of the migrants and eastern states and uni students coming into the market. Okay, I'm going to look at now affordability and interest rates. So again, comparing Sydney and Perth. So these particular charts, what we've got here is the median house price in Sydney and also in Perth. And then what we're doing is tracking the percentage of full-time earnings in Perth and Sydney against the average mortgage rate. So in Perth, if we follow the maroon line, we can see that in Perth, we've actually, back in 2011, when interest rates were quite high, we were spending 35% of our full-time earnings on a mortgage. Now, because interest rates are so low and our incomes are much higher, we're just shy of 100,000, even much higher than Sydney, we're only spending 15% of our full-time earnings on our mortgage. If we look at Sydney, on the other hand, again, they were at around over 45% back in 2011. They're still at 35% of their mortgage is actually spent on, or 40% of their income is spent on their mortgage. And if we, let's fast track 1 year's time, the banks have come out and mentioned that they see price drops in the market as a result of an interest rate rise. Both CommBank and ANZ have come out with similar figures. And on the East Coast, I don't think that I disagree with that. And the reason being, if we increase interest rates by 1% in Sydney, this particular figure here shows that they're spending $33,000 on their mortgage, and that will go up to $43,000, and it will go from 35 to 45,000. 45% of them actual income will be spent on their mortgage. Same scenario in Perth. We go from around 14,000 or 15,000 in our mortgage to 18,000 as a direct cost, but only from 15% to 20% of our income is spent on our mortgage. So that's that affordability element. We are so much more risk averse to interest rate rises if they do go up than Sydney. The other factor I think is particularly important because of that volatility and having a look at 1% increases going up to from 35 to 45 and such a significant impact. I think the RBA is going to be really careful about increasing interest rates. We, on the other hand, because they can't afford it, monetary policy, and which the government uses to control interest rates to control the markets, they're going to be very nervous about increasing interest rates because of the impact on the East Coast. And monetary policy is always dictated by the Melbourne and Sydney markets, not by Perth, because we are as much as we're a big contributor, we are a smaller population base, and they tend to be East Coast centric in relation to these decisions. So we're going to end up with higher wages, major property price growth, lots of population growth and demand coming into the market, and then we're going to remain with the lowest interest rates historically that they've ever been. So it's a very positive thing for Perth property. Okay, so what have we learned? And again, as I mentioned, this was a quick summary, so I apologise if I have gone over a little bit, but there is much more detailed information available. So essentially, it's very clear Perth is in an undersupplied market. We have some additional approvals, but that's going to be a slow burn to get that product into the market, and it's not really being catered for the new demand that's coming into the market as of the 1st of December announcement. The nature of migration, we're going to have big spikes, and the number of available properties in the market at being only 8,000 is well under our equilibrium amount of 14,000, and I suspect that 8,000 is probably going to be 6,000 very shortly. Same with the rental properties, 2,000 is going to drop, and as the uni students, skilled labour, east states and the expats return, those properties are going to be taken up very quickly. As noted, we're being very affordable, and only 15% of our wages being spent on a mortgage versus 35 in Sydney. We will be able to, we've got a long way to go with price growth, and we have very little downside as opposed to the East Coast markets. So that's it for me. There's a couple of buttons, or a button that you can push below to register for more information. We have a full detailed report, much more. As I said, I could speak for an hour on each of these topics rather than putting it into a very short presentation. So you can register for that. If you want any specific property advice, if you're looking at buying, if you want to know if your rents are at the right level based on what's happening, or when to actually release, or should you wait a little bit to get the maximum rental based on what's happening with demand, all of those things we're more than happy to assist with. And one thing I'd love, if you have made it to the end and you found that interesting, I'd love to know of any topics you'd like me to cover for future webinars, because I'll be doing these quite regularly. So thank you very much. I'm not sure how long that went, but hopefully it was close to the 20-minute time frame.